In this session, I'm going to give you a basic overview of the dividends as well as share repurchases. See, normally in any company, whatever the profits they generate in a particular year, out of that particular profits, they can share those profits with their shareholders. They can make a portion of payment of the profits to the shareholders, and the remaining can be retained for further operations of the company. So whatever are the typical payments that are being made to the shareholders out of the profits that are generated, I can put them in the form of either dividends or the share repurchases. And what we see is they are one of the largest component as a part of the total return which is being expected by the investor. Probably I can look at it as the contribution of dividends as well as capital gains. So these two things put together is contributing to the total return of the investor. So understanding the dividend become more and more helpful from that particular dimension. Now, if at all I'm looking at the dividends, there are different forms of dividend. There are different ways in which the dividend can be paid to the various shareholders. One, it's a regular cash dividend which the company pays on a regular basis in the form of cash. Probably it could be quarterly or semi-annual or annual kind of a basis. On a regular basis, the payment is being made out of the profits of the company. And this should be more stable or increasing. The more it is stable or even if it is increasing, it can be visualized as a positive sign of the growth of the financial health of the company. But it can't be completely unpredictable kind of a number. This is a very stable amount that is being paid on a regular basis, and there is an expectation from the investors perspective also that on this particular day we would be receiving at least this much in the form of dividend. So it can't be a fluctuating kind of an amount. It is more and more regular. It should be more and more stable or slightly increasing. If it is slightly increasing, it talks more and more about the positive signs in the growth of the company. Then there could be something called as either extra dividend, or sometimes we call it as a special dividend, or sometimes called as irregular dividend. Whatever is the name that is typically called as, this is one more form, especially when the company is having excess cash in one specific year. Probably they have done extraordinary business in an year and they want to distribute that excess profits in the form of cash to the shareholders just to keep them happy, right? So it should not be given as a part of regular dividend, because the moment it goes as a part of a regular dividend, the expectations for the next quarter, the next semi-annual years also will keep increasing. So this is like an extra dividend that comes up once in a while, especially when the company is able to do much better. Generally, this is being used very heavily by cyclical firms. Cyclical firms, their business is more and more going with peaks and troughs. In this kind of peak, when they have generated extreme profits, they'll try to make this extra or special kind of a dividend and when they have gone, when they are completely in this particular phase, when their profits are dying out, they can even retain paying the dividend. They can even refrain from paying the dividend, which can still keep the confidence of the investors high, because they can still feel that this company will pay again when it is booming up. So this is one way that extra or irregular kind of dividends are being paid. As a part of the regular cash dividend, there could be something called as dividend reinvestment plans. Whatever whatever the dividend that the company is paying to the investor, to the shareholders can have an option to reinvest that dividend back into the company. That is what is called as a dividend reinvestment. On an automated way, there could be a mechanism wherein the dividend can be reinvested back into the company, which are called as dividend reinvestment plans. And whosoever have subscribed for that dividend reinvestment, either the company will issue additional shares for them, because they are contributing some more additional capital into the business. Their dividend, instead of taking it in the form of cash, they are giving it back, which means they need to be compensated with additional shares. So the company will issue new shares and distribute them to those who have opted the DRP. For all of them, at regular intervals, the company will issue new shares, or the company will buy back the existing shares from the market, buy back the existing shares from some of the existing shareholders, and give those shares to the DRP investors, so that there is no new number of shares that are getting increased. It's only the ownership change that is happening in the process. So, for a regular cash dividend, instead of just talking about the cash and the receipt of cash, even there is a possibility of the dividend reinvestment as well. And coming to the other important aspect of dividend, one is called as a liquidating dividend. Especially, it's looked at as a negative sign of the company when the company is declaring a liquidating dividend, because this is generally done when the company has got is going out of business. So it's either bankrupt, right, or it's going to shut down its business. And whenever it's planning to shut down, whatever are the proceeds that are there out of the business, or by selling the various assets of the business, they are the ones that are typically distributed to the shareholders. And this kind of dividend is called as liquidating dividend. Otherwise, it is typically treated as return of capital. So that's where whatever the taxation that is applicable to it, it is based on the capital gain. Whatever is the capital gain that was achieved, the tax on it, which gets treated as a capital gains tax, would be paid on the top of it. Then we can also look at the other form of dividend, which is stock dividend. This is one form of a dividend where the company does not pay cash. Rather, directly it pays additional shares to the investors. So no cash is being paid. It's they are given, every shareholder will be given some percentage additional shares. So generally it is quoted in the form of percentage. So whenever it is said, let's say 10% stock dividend, it means a person who is having 10 shares, he would be given one additional share, so making his total tally of shares to 11. So whenever we talk about a stock dividend, it is in the form of percentage, and it's only the, instead of cash being paid out, corresponding to the cash, additional shares would be paid, which means the cash would be retained with the company. So this would result in number of shares outstanding will typically go up. Nothing else might change, but the number of shares outstanding will typically go up, because for every existing share, some percentage of new shares are being created and issued, right? So in the stock dividend, we see that whenever a company has declared any kind of stock dividend, we see that the outstanding shares are typically going to go up, but the market value of the shares is not changing at all. It is more or less stable, because whatever the extent number of shares go up, number of shares are going up, the share price is going to come down accordingly. So which means the market value, which is the number of shares multiplied by the share price, that is going to stay stable itself, because no new activity is being performed by the company. It's only the number of shares that have gone up, which means per share price has to typically come down. And from a financial statements perspective, the retained earnings, the retained earnings typically are going to go down, because additional shares are issued out of the capital that is present in the retained earnings. Retained earnings are going to go down and share capital is going to go up by the same amount. So this is the typical adjustment that happens to the financial statement, which means only the equity components are typically changed and nothing else is happening here. So this is what happens in case of stock dividend. And just to understand the financial statement implications, as I said, one, market value does not change and number of shares are typically going up, which means the earnings per share is typically going to drop, because the number of shares are typically going up, the overall earning is not changing. The earnings per share is going to drop, and as I said, the stock price is also going to drop accordingly. But the overall wealth of the investor is not going to change in any way through the issue of stock dividend. Whereas when I look at any of the three methods which I discussed earlier, the regular cash or special or liquidating dividend, special or irregular kind of a dividend, or a liquidating dividend. What we see is in all these three, there is a transfer of cash from company's accounts to the shareholders' accounts. So from a company's perspective, cash is down. Cash is down means current assets are down, and correspondingly the retained earnings are down. Current assets are down, retained earnings are down, so the overall total assets of the balance sheet is typically down. The total assets present in the balance sheet typically down, and because the retained earnings are down, you could very well see that the market price also should be down. Market price of the share should typically go down, right? Because the dividend has been declared, the market price of the share typically has to go down. Number of shares are not changing, so which means the total market value or the market capitalization is typically going to go down when there is a payment of cash from the company to its shareholders. Generally, we see that if a dividend of X dollars is being declared and the current share price of the company is Y dollars, what we could see is after the declaration of the dividend, the share price of the company would be somewhere at around Y minus X kind of dollars. The reason being, the cash outflow happens in the company and the equity value will come down, because on the assets the cash is coming down and the equity is coming down, overall result in a fall in the market value of the company. So this is one thing with respect to regular cash or special dividend or liquidating. But when I look at it from the perspective of stock dividend, this kind of thing does not exist, because whatever are the additional shares that are created, that is compensated by the fall in the share price, and overall market value or individual's wealth is not getting affected because of that. Whereas in case of these cash dividends, yes, after the declaration of the dividend, the market value has typically gone down. But look at it like this, from a shareholder's perspective, he has already received some value in the form of dividend, and the new market value is what is the total benefit that he has received. So what we typically see is, even from a shareholder's perspective, the total wealth, if I include the dividend amount that he has received in the form of cash, the total wealth is not going to change. But when I look at it only with respect to the stock and the stock price, that is where I see that the stock price will drop without any change in the number of shares outstanding. In the same lines, we do have one more important way the companies operate, or companies play with the share prices through the mechanism of stock split. Though this is not a form of a dividend, right? Dividends wise, those are the major forms. Either there could be a regular cash dividend, or there could be a special dividend, there could be a liquidating dividend, or there could be a stock dividend. So these are the different ways in which the dividend distribution happens. But in the same context, looking at a few other corporate actions which the companies can take, we can talk about the stock split. In this, whatever is a bigger share, especially this is done when the share price is perceived to be exorbitantly higher. One single share gets broken off into multiple shares, generally like 5 to 1 split. It's expressed like a ratio like this, which means, sorry, 5 for 1 split. So one existing share gets broken into 5 shares. So because of this, the face value of the share is going to become 1/5 of the original face value. The share price also typically has to become 1/5 of the original share price. And the number of shares now will become 5 times. So overall, again, the market value, which is the number of shares multiplied by the share price, the market value is not going to change. The ownership position for anyone is also not going to change. But obviously the EPS, the earnings per share, now number of shares have gone up, earnings did not change. Earnings per share is also going to fall proportionately, because shares have become 5 times, the earnings per share should fall 5 times. But the overall owner's position and all are not changing anymore. The main motivation being the share price is exorbitantly higher, which will prevent regular investors to invest in it. So there is a possibility of the liquidity issue, especially if the number of shares are much lesser and per share price is much higher, because not every investor can typically opt for purchasing those kind of shares. So when there is a stock split, because one single share is being split into so many, one, the number of shares that are held for trading is typically increased, and at the same time the share price is coming into a comfortable range. Because the share price comes into a comfortable range, it can enable a quite liquid trading process to be existed. So what we see nowadays is, especially when the share price has gone up, the companies are typically getting themselves involved into the stock split kind of transaction. And as I have already said, the number of shares are going to go up, the stock price is going to fall, the EPS is going to fall, the dividend per share also will fall because the number of shares have gone up. The dividend per share is going to fall, but from an investor standpoint, the total dividend that is going to receive is not going to change because the number of shares have typically gone up. So, though he is getting lesser dividend per share, he is having more number of shares. So, overall, there is a balancing that is typically happening, right? So, whenever we are looking at the stock dividend or stock split, one thing we need to understand is they are resulting in the outstanding shares going up, the share price typically going down by that extent, but the market value of the share remaining more or less constant. So because the market value is remaining constant, the shareholder wealth is also remaining constant. So as we said, the major reasons companies look at doing these things is keeping its stock price in an optimal range. Every country, there is an optimal range that is perceived, and to keep the share price within that most optimal range, they try to go ahead in terms of doing stock splits. Now again, a stock split typically from an investor's community perspective, from a psychology of the investor's perspective, it is seen as a positive signal for the future growth of the company. So people expect that a company has done the stock split because it is expecting that it would be growing in future. Even more, an increase in the stock price could result in few number of trades happening. So just to take into account, just to bring in more and more comfort into the trading process, the company has got into the splitting of the shares. So there is a tendency that the stock price will rise once the split or dividend is being announced, but only up to a certain point. Now the next quarter, if the company is not able to show a performance through its quarterly reports, if the next quarter the company is not going to show its performance in terms of the earnings, just after the stock split, what we typically see is the prices are going to have a very bad impact. They are going to go back, or even they are going to worsen the situation as well. So that's where the companies need to be careful about. But at the same time, though more number of trades can be done, more volumes can be generated, what we typically see is the brokerage fees, especially for small price stocks, for low price stocks, the brokerage fees should be our brokerages fees are generally high, which means even from that perspective, there could be an impact on the liquidity. So, from both dimensions, the liquidity factor needs to be evaluated. One, a very heavy price can stop the trading, can prevent everyone from getting into the trading process. Very low stock price, there is a possibility of high brokerage fees and commission to be operating. So both these things need to be evaluated hand in hand to see what is an optimal stock split that is good for the company. And on the same lines, we see a reverse stock split, which is nothing but stock merge or combine. So instead of one big share getting split into multiple smaller shares, in a reverse stock split, what we see is all these multiple smaller shares get combined into one bigger share. So because of this one, the stock price, the share price per share price is going to rise because it's a summation of five single individual shares combined into one. the share price is going to increase, the earnings per share is going to increase. But remember, the market valuation or the ownership stake are not going to change, right? Because as the share price is increasing, the number of outstanding shares is decreasing. Overall, the market value of the share is not changing. But again, the intention is probably the price would have gone extremely low. The prices per share would have gone extremely low. So a consolidation will try to increase the share price by clubbing the few shares into one single share. And in some cases, if the share price is extremely low, even investors will have a doubt in terms of investing in that particular share. It may lose the investment grade altogether. And along with that, even there could be a threat from the exchange as well. If the share price has gone extremely low, even from an exchange perspective, there could be a delisting of that particular share. So, just to cover those kind of situations, there is a possibility that a reverse stock split can happen and it can be merged to become one full share. And even this can be a possibility for a firm which has got into financial distress. The share price has fallen down drastically, and just to maintain a decent listing requirement for that particular share, even then the reverse stock splits can very much occur. But whatever it is, if I have to look at the impact of all these decisions on the financial ratios, there are two ways. Anything to do with the cash, regular cash, special cash, whatever, as we have already discussed, the cash is going to go down, which means the current assets is going to go down. And because of that, even on the liabilities and owners equities perspective, the retained earnings is going to go down. And because of that, now I could see all the current ratios, all the liquidity ratios, they are going to suffer because current assets are down. The liquidity related ratios are decreasing, current ratio, quick ratio, all these are decreasing. But at the same time, the debt to total assets ratio is increasing because total assets have gone down, debt did not change. So debt to total assets ratio has increased. Debt to equity ratio has increased because equity has decreased but debt did not change, which means here I could see that my leverage ratios are typically increasing, the liquidity ratios are typically decreasing. Whereas anything to do with the stocks, stock dividend, stock split, there is no change in the current assets, or no change in the assets, no change in the liabilities, no change in the equities. It's only a repackaging of the, in case of stock dividend, it's only repackaging of the equity. In stock split, even that change is not there. There is no change in the financial statements at all, which means there is no point in there is nothing change as far as the liquidity ratios are concerned or even the leverage ratios are concerned. It's only the number of outstanding shares are increasing and nothing else is changing. So stock splits and stock dividends do not have any kind of impact on the financial statements, whereas the cash dividends, they could decrease the liquidity ratios and could very well increase the leverage ratios of the firm, right? Now let's try to understand the chronology with respect to the dividend payments. What are the key dates that are important with respect to dividend payment? We talk about one, the declaration date, the date on which the dividends are declared. Declaration is not payment. This is the date on which the board of directors typically meet, and they confirm how much dividend needs to be paid to the investors, and they approve the dividend payment, and even they decide the date on which the dividend payment has to happen. All these things happen as a part of the dividend declaration date. The amount, the date of payment, all these things are decided on the declaration date. The most important of these various dates is the ex-dividend date. Now I have to identify who are the recipients of the dividend, because the stock gets trading quite often. I need to know who are the eligible people for the dividend, right? So this ex-dividend date is typically taken as the cutoff date. Whosoever is a shareholder as on this particular date, as on the end of this particular date, whosoever is the shareholder, they would be entitled to receive the dividend. Others, any kind of buying and selling that happens after the ex-dividend, any kind of buying of the share happens after the ex-dividend date, that party is not entitled for the dividend that is going to be declared. The party who has sold it, they are still going to declare, they are going to still get the dividend. So on or after the ex-dividend date, anything that is going to be purchased, the new owner is not going to receive the dividend. It's the old owner only is going to receive the dividend. So probably I can always look at it as the first day on which the stock will trade without the dividend, which means there is always a decent possibility that the stock price will fall on this particular ex-dividend date by the amount of dividend that is going to be declared. So if X is the dividend, Y is the share price until the previous day, there is a good possibility that the price will come down to Y minus X. But in general, because of the tax, it will be coming out as after tax X. So Y minus of X into 1 minus T. Post tax value of the dividend is typically coming out as a decrease. So that's the ex-dividend date, very key date. It's the first day on which the stock goes into the trade without the dividend. So you'll find a completely drop in the price because of that. And in general, the whosoever is the owner of the share just one day before this ex-dividend date, they would be the eligible entitled people for the dividend that is going to be declared. So because of that reason, we'll talk about another important date, which is holder of record date. So this is the date on which the real owners of the shares are identified. As on that particular date, whosoever are the real owners of the shares, they are identified, and the dividends would be made a payment to them. Now this is typically 2 business days after the ex-dividend date. Ex-dividend date plus 2 days. The reason being, all the actual owners of one day before the ex-dividend, because of the stock settlement happening in T plus 3 business days, the whosoever have bought and sold the shares on this particular day, their information would be known only 2 business days after the ex-dividend date. So as on this date, the typical identification or typical workout would be done in terms of identifying who are the owners as on one day before the ex-dividend date, so that the settlement of the dividends can be done for those people. So generally we see that because of the T plus 3 settlement cycle for stocks, the holder of record date will be 2 days after the ex-dividend date. And on this day, the actual parties who are going to receive the dividend, that list is identified, and the checks would be started to be prepared for them. And finally, we look at the payment date, that day on which the actual cash gets electronically transferred to the different accounts of the different investors who are identified as on this holder of record date. So the dividend checks are mailed to them, payment is transferred, and the real payment gets reflected into the accounts of the various shareholders on this particular day. Again, there could be probably around 10 to 15 days from this ex-dividend date in terms of making the payments in reality. And the declaration date could be anywhere 15, 20 days, 1 month, 2 months, even before the ex-dividend date as well. So these are the important dates, but most important of them is the ex-dividend, because that is the day you see that in the stock market the price of the share will typically be much lesser or goes down by the extent of dividend that gets declared. So that is the day on which you see the price variation of the stock compared to the previous day is going to be significantly higher. So a good understanding of the corporate action taken by the company needs to be understood, because a sudden surprise in the share price drop need not be taken as a panic situation, right? All right. In this session, I'm going to introduce you to the share repurchases. Just like a dividend case where the company is having some, where the company has generated some profits, it has some excess cash, the company can think of either distributing this excess cash in the form of dividends, or it can think of using this excess cash to buy back its own shares from the investors, right? So this buying back of the own shares, own equity shares from the investors, is what we are calling as share repurchase. So as a company, there is some cash, and that cash is being used to buy back some of the shares from the existing investors, and that is what we are calling as the share repurchase mechanism. So as far as the share repurchasing is concerned, I can look at what are the different methods in which the shares can be repurchased. We'll talk about quite a few methods. We'll talk about the open market mechanism where the shares can be repurchased. We will talk about a tender offer, or we can talk about a possibility of a Dutch auction, or there is a mechanism of direct negotiation. So there are different kinds of mechanisms in which a company can typically buy back the shares from the investors. So we'll discuss about them. And in case the company buys back these shares, how would the financial statements get impacted? A very important point for us. What kind of impact it will have on the different financial statements? What are the entities of the financial statements that typically get changed? How would it impact the earnings per share? how would it impact the book value per share? We'll take them out, we'll look at them using a couple of examples. And one more important thing is, can I differentiate what is the key difference between the cash dividend? See, because the excess cash, the company can either pay the dividend or it can do a share repurchase. So is there any way I can evaluate which one is better compared to the other? So these are the different things that we can discuss in this session. So starting off with the different methods that are available, if I have to talk about the open market, buy the shares from the open market, which means just like you and me, we purchase the shares, the company also will purchase the shares at the current market price through the secondary market only. At the current market price, it is going to purchase the shares. And how many shares that needs to be purchased, the board would be approving them, and based on whatever the board has approved, those many shares can be purchased by the company in the open market. And probably it can very well work out on the timing, especially when the price is much lower. When the price has fallen, it can go for a buyback so that it can buy back the necessary number of shares at a lower price. So the timing of the purchase can be very much suited to that, can be selected by the company, and it can be taken as an advantageous thing to the company itself. The buyback can happen especially when the prices are slightly on a lower side. So this is one way in which the company can buy back its own shares. Second, it can go through a tender offer process. In a tender offer, what is that we are saying? The company will initially fix the number of shares that it wants to purchase, and it also will fix the price at which it wants to purchase, and it makes an announcement of the same. So it is fixing the number of shares, and it is fixing the price, and generally this price is a premium just to lure the investors to surrender their shares, to tender their shares. So generally a premium to the current market price is being fixed. So this is being announced. So which means the investors or the shareholders, they can start tendering their shares. Sometimes what happens is they can tender more than the required number. The company wants only these many number of shares. But when the company has floated this at a premium, there is a possibility that more number of shares will be tendered. If more and more number of shares are tendered, the company can purchase them on some kind of a mechanism, probably on a pro rata basis. It can very well go ahead with. But if the same thing happens through a Dutch auction mechanism, instead of a tender offer where the price is fixed, it can go for a Dutch auction kind of a mechanism wherein it itself can get some kind of bids from the different sellers, the prices at which they are going to tender their shares, and based on that it can determine the lowest cost, what could be the cheapest way of purchasing the shares, what is the kind of a lowest price at which it can purchase these many shares. So it will fix the number of shares that it want to purchase, but instead of fixing the price, it will choose the Dutch auction mechanism wherein the various bidders are going to submit the price at which they are going to sell their shares, and it can choose whichever is costing the company the lowest, and can very well purchase the shares from those concerned parties. Or there could be a direct negotiation mechanism itself, generally done with a single largest shareholder. Apart from the promoters, whosoever are the largest shareholders, a direct negotiation with those parties happens and a price to, so their shares would be bought back by the company because there is a possible takeover threat from that single largest shareholder. So just by purchasing the shares from that particular party will avoid the takeover threat, and at the same time there is a possibility that the shares can be offered, the shares can be purchased at a premium to the market price, so that that single largest shareholder will get convinced and probably would try to sell off his shares. So a full block of shares can be purchased from one single party itself. So one on one side the takeover threat would be reduced, and on the other side, the company need not face a drop in the share price because of so many shares coming into the market, so many sales happening into the market, and the price of the share falling drastically. So that kind of negative phenomenon can be avoided by getting into the direct negotiation kind of a route. So more than the market value is being paid, a premium is being paid. So the seller's wealth is typically increased, and all the remaining shareholders, their wealth is decreased in any kind of a transaction where the premium to the market price is being paid. Even in a tender offer where the premium to the market price is paid, or even in a direct negotiation mechanism where the premium to the market price is being paid, what we see is the sellers or the people who have tendered their shares, they will receive a much higher wealth, whereas the others who have not tendered or the other existing shareholders, their overall wealth is going to decrease as a part of this transaction. Right? So these are the different ways in which the repurchasing can happen. In some cases, it is more and more favorable to the company. In some cases, it may act against the company as well. Right? Now, we can look at how would the financial statements be impacted, especially if a share repurchase happens. Because as a few important points, any share repurchase, we see that the number of shares outstanding is going to decrease. Number of shares outstanding is going to decrease because the company is buying back some of the shares. So because of that, automatically all other things remaining the same, the earnings per share is going to increase. But here, one important thing that we need to see is the mode in with which the buyback is happening. The mechanism with which the buyback is happening. Is it through the own funds of the company, or is it through the loan funds? And both of them have an implication. See, when I say I am doing it with the own funds, probably these own funds could have been invested in some kind of an investment. And because of this investment, the investment income is going to come. But the company is foregoing that investment income. So, because of that foregone investment income, the earnings could decrease. So, the earnings are decreasing, and at the same time, the number of shares are also decreasing. But how would the earnings per share will decrease will be decided based on whether this is decreasing faster or this is decreasing faster. But one thing is for sure, the investment income is getting compromised, which means the net income of the company is going to drop because of this. Even when the company is using loan funds, the other way to look at is because of that borrowing, the interest cost is going to add up. So because of the interest cost, again in this case also the net income is going to drop. Again the same logic, the overall earnings are dropping. So to what extent, in which case the EPS is higher and in which case the EPS is lower needs to be evaluated, because whether E is dropping faster or S is dropping faster is something that needs to be understood to get a clarity in terms of what would be the implication on the EPS because of this buyback. Because we see that the net income is getting decreased, the number of shares are getting decreased, so what will happen to the EPS? So from that perspective, let's take up one simple example to understand that concept. So let me take one simple situation where uh, a buyback is being planned, right? A share repurchase or buyback is being planned, and before buyback, let me say that the number of shares that are outstanding are, before buyback, number of shares outstanding before buyback, let me say that that number is some 10,000. 10,000 shares are outstanding before the buyback, and the share price before buyback, let's say the share price before buyback is $100 per share, and the EPS at that particular point, let me say it's around 10 $10 per share. Let it be the EPS at that particular point. And the company, let's say, has borrowed for a buyback, right? So the buyback, whatever it is planning, let's say it want to buy back 1,000 shares. So it wants to buy back, let's say, 1,000 shares, and because the share price is 100, so it wants a total loan. Let's say it is taking a loan of the 1,000 shares multiplied by 100 per share. So let's say it is planning to take a loan of 100,000 bucks. It's planning to take a loan of 100,000 bucks, and let me assume that the interest rate or the cost of borrowing, let's say it's around 8%. Now let's see what is the kind of an impact that is present on the EPS before the buyback and after the buyback. Okay, let me take EPS before the buyback. So before the buyback, what is my EPS? Whatever is the earnings, so it's already there. The EPS before the buyback is going to be 10. Now I want to find out what is the EPS after the buyback. Alright, so how do I compute EPS after the buyback? First of all, I need to know what are the total earnings. Total earnings before buyback. So I have EPS and I can multiply it with the number of shares, right? Number of shares, which will give me the total earning before the buyback. And now I can talk about the cost of funds. What is the cost of funds? It has borrowed at the rate of 8%. So let me assume that this cost of borrowing is after tax, not pre-tax, right? So the cost of funds coming out to 8% times whatever is the loan that has been taken. So the interest, so cost of funds are typically the interest cost coming out to 8,000, which means earnings after buyback, it is going to be 100,000 minus 8,000. So the earnings after buyback is going to be 92,000, And I also need to know the number of shares after buyback. Number of shares after buyback is working out to, initially there were 10,000 shares, but 1,000 shares are being bought back. So 9,000 shares are there. So which means EPS after buyback, I can very well look at it as the earnings after buyback divided by the number of shares after buyback, resulting in an EPS of 10.22, which means earlier the EPS was 10, now it has gone to 10.22, which is a clear indication that the EPS has gone up because of the buyback. But this can't be a generalized statement. Let me just change the numerical a little bit for you. Instead of borrowing it at 8%, all else remaining the same, I'll keep all these things exactly the same, right? The EPS also I'll keep it the same. The buyback also I'll keep it the same. The loan amount also I'll keep it the same. But the only difference I'll bring in is the cost of borrowing I'll change. And because of that, what I could see is, let's see what has happened. The total earnings before buyback is this much. The interest cost now is 12,000 bucks, resulting in earnings after buyback being 88,000 only. Number of shares is 9,000, resulting in EPS after the buyback of 9.7, which means the EPS has fallen now. But if I see in this whole story, the difference is primarily with the cost of borrowing. The difference is primarily with the cost of borrowing. Cost of borrowing lesser than something, I have seen that the EPS has gone up. Cost of borrowing greater than something, the EPS, overall EPS has gone down. Now what is that something? So just to understand that what is that something, probably the same example, this time I'll take it with 10%. The same example, I'll take it with 10%. Let me see that the EPS is exactly equal to 10 now. So if the cost of borrowing was less than 10%, I see that the EPS has gone up. Cost of borrowing is greater than 10% in this example, the EPS has gone down. But what is that 10%? I could see that the 10% is nothing but the earnings yield. The 10% that is coming up is the earnings yield, which can be defined as the EPS divided by the share price. The EPS divided by the share price working out as earnings yield, and what we typically see is if the cost of borrowing is lesser than the earnings yield, we see that the EPS, the net EPS is going to go up, and if the cost of borrowing is greater than the earnings yield, we see that the overall EPS is going to go down. But this cost of borrowing, let me take it as after tax. If pre-tax cost of borrowing is coming up, probably do it as KD into 1 minus T and convert it into an after-tax cost of borrowing. Compare it with the earnings yield, which is nothing but EPS divided by the share price, which can result in whether the EPS is going to go up or go down because of this share repurchase. So if the share repurchase is typically happening with borrowed funds, in some cases it is increasing the EPS, in some cases it is decreasing the EPS. Whereas when I'm typically looking at my own funds, the EPS may not change because the cost of borrowing, because the investment income that would be sacrificed would be exactly in line with the decrease in the number of shares. So this is one way we can evaluate the impact on EPS because of a share repurchase. On similar lines, I can look at the impact of share repurchase on the book value per share. So to understand that kind of an impact of buyback on book value per share. If I have to understand that simple impact also, let me look at a scenario probably for a company whose share price currently is 100 bucks, right? And there are number of shares outstanding. Let me take it that the number of shares outstanding is 10,000, which means based on this I have the market value of the equity of the company coming out to the share price times the number of shares outstanding, working out to this much. And let's say the company wants to uh, buy back 100,000 worth, the number of shares. So buyback amount, let's say the company wanted to buy back 100,000 worth, which means buyback number of shares this time coming out to 100,000 divided by the share price of 100. So it wants to buy back 1,000 shares in this case. And just to see the kind of book value, right? The book value of the company, let me say that it is around 800,000. The book value of the company is 800,000. Now I want to see what is the impact on the book value per share before and after the buyback. So before the buyback, if I want to see the book value per share, the book value of the company is 800,000 divided by the number of shares outstanding. So the book value per share is 80 before the buyback. But after the buyback, what is the book value? Okay, after buyback, the book value of the company, because of the cash going out, the book value of the company typically has gone out. So 800,000 minus 100,000, because there is a cash outgo. So the book value has typically cash has gone out, which means the equity is also gone out. So after the buyback, the the book value is going out to be 800,000 minus 100,000, which is 700,000. And I'm looking at number of shares after the buyback. Number of shares that are outstanding is 100,000, 10,000 minus 1,000. So it is clearly seen that after the buyback, the book value per share has typically gone down. From 80, it has gone down to 77. Whereas on the same lines, all else remaining the same, if I can see that the book value instead of 100,000, it is 1.800,000, it is 1.2 million. Now what I could see is earlier the book value per share was 120, now it has gone to 122.22, which means the book value per share has actually gone up in this case, the book value per share has gone down in this case. So which means again, in some cases a share repurchase is going to increase the book value per share. In some cases, the share repurchase is going to decrease the book value per share. Now, what is to be understood here? When will it increase the book value per share? When I see that the book value per share before buyback, if it is greater than the market price, right? Or if the market price is lesser than the book value per share before the buyback, either of the ways. If book value per share is greater than the market price of the share, we see that the net will result in increasing in the book value per share. But if I see that the original book value per share is lesser than the market price of the share, the net is going to result in a decrease in the book value per share. So the situation in which the book value per share increases and in which case it decreases need to be very clearly understood. And so apart from these financial statements impact, I would also like to see whether declaring a cash dividend is appropriate or a share repurchase is appropriate. If at all the company is having some excess cash, should it give a dividend or should it do a share repurchase? Now, what we typically see is share repurchase is also a kind of alternative to dividend. The reason being that excess cash, instead of paying it in the form of dividend, it is repurchasing the existing shares. So the overall number of shares is going down, and because the overall number of shares is going down, the EPS is going to go up, all else remaining the same, and at the same time the market price is going to go up. Even here, the dividend is cash outflow that is being made, which will result in the market price going down. But if I see the total value to the investor is both the dividend as well as the market price, in which case what we see is, if at all the tax treatment is the same, if the dividend is treated at a different rate of tax from the capital gains, we see a difference. But ignoring the tax portions, if at all there is no difference between the dividend tax and the capital gains tax, what we could see is there is no much of a difference existing between a cash dividend being declared or a share repurchase being done. Because any company, once it has paid a dividend, the market price is going to go down, but the total worth for the investor is both the dividend which he has received right now plus the change in the market price. Whereas in case of share repurchase, though there is nothing that is being received by the investor today, the increase in the market price is being completely compensated by the increase in the number of shares. The decrease in the number of shares resulting in an increase in the market price. So what we see is literally there is no difference between the declaration of cash dividend or going for a share repurchase, assuming that there is no difference in the tax. But if dividends are taxed heavily, then there could be a benefit to the investor if the company goes with a share repurchase. If the capital gains are taxed heavily, it would be beneficial for the investor if the company declares a dividend compared to the share repurchase. Otherwise, there is not any kind of a difference between these two methods, right? So a basic understanding of the share repurchases, different methods, how it impacts the financial statement will really help us in evaluating the alternatives quite comfortably. All right.